Here's today's Money Metals Minute, brought to you by MoneyMetals.com. They reversed themselves yesterday in trading and gave back most of Monday's gains. Stocks, crude oil, and precious metals all finished lower. A report from the World Gold Council also weighed on metal prices. It showed central banks around the world, which have been aggressively adding to reserves, reduced their purchases by 40% in the second quarter. Now here's a special report from Mike Gleason of Money Metals Exchange.
It is my privilege now to be joined by Michael Pento, president and founder of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael is a money manager who ascribes to the Austrian School of Economics and has been a regular guest on CNBC, Bloomberg, and Fox Business News, among others. Now, as you pointed out in an article you wrote, we have a big disconnect between what the payroll report and the employment numbers are showing compared to the tax receipts the Treasury Department is collecting. Talk about that if you would, and then also let us know what conclusions you're drawing from these numbers.
Well, unfortunately, the conclusions I'm drawing is that the payroll numbers aren't telling the truth. So if you listen to the Labor Department, the number of net new jobs created year over year this fiscal year so far, it's going to end at the end of September. So we have almost all the data in. There has been 1.66 million net new jobs created. And one would assume if you have all these people in a net basis in the workforce, that tax receipts would be increasing. And yet you see corporate receipts are down 12.8% year to date, and individual tax receipts are down 0.4% year to date. Furthermore, there's something called the FUTU tax. And that's basically a tax, unemployment insurance tax, on the first $6,000 of anyone employed. So unless these people that are employed, supposedly full-time in gainful employment, are earning less than $6,000 a year, these people should be paying into this pool. And those receipts are actually down year over year. So I believe that the Bureau of Labor Statistics is inflating this data, and I believe the quality of the data, in other words, the number of jobs created and the quality of those jobs are mostly part-time in nature and very low-paying service sector jobs, which, by the way, would also explain the absolute lack of productivity. Don't forget, in case you don't know, in case your audience isn't aware, productivity has dropped for 3 quarters in a row. And the productivity of part-time barmaids is not very high. That would explain the discrepancy between the two numbers that I just described, between the Bureau of Labor Statistics and the tax receipt data, and it also explains why I think this economy is most likely in a recession right now.
Now, there's something else here that doesn't seem to add up. We continue to see records in the stock market, but earnings are not keeping up with the rise in share prices. It's hard to know who is actually buying shares. Zero Hedge has reported that retail investors don't seem to be buyers. So is it possible that the Fed might be actively playing in this market? I mean, we do know the Swiss Central Bank has been buying U.S. stocks.
Sure.
And certainly the Bank of Japan is a huge buyer.
Sure. I mean, is it that much of a stretch to believe that the Federal Reserve is doing exactly what other central bankers are doing? I think we're all headed towards helicopter money. This is where this is all going to head up. So if you look at earnings on the S&P 500, it is down 5 quarters in a row. 5 quarters in a row. And most likely will be 6 quarters after this earnings season is wrapped up. So if you have 6 quarters in a row of falling earnings, what is supporting the stock market, which is, by the way, trading at record highs? If you look at median PE ratios, if you look at price to sales ratios, if you look at total market cap to GDP ratios, this is the most expensive market in aggregate that we have ever had in history. And it's even more expensive when you think of the fact that you have earnings that are most likely falling, and that means negative 6 quarters in a row. So who is inflating the stock bubble? It has to be the Bank of Japan, the Swiss National Bank, the European Central Bank, and the Fed, even if they're not directly buying ETFs as they are over there in the maniacal inflation-seeking retirement colony in Japan. You at least have to admit that keeping interest rates near zero for 90 months and inflating the Fed's balance sheet by $3.7 trillion has bent down the yield curve to almost a flat level where it sits now at a 10-year around 1.5%. That has forced everybody in a wild search for yield. And where are they going? They are going every place from municipal bonds to collateralized loan obligations to REITs to every type of fixed income proxy there is, even to high-performance sports cars and art. So every asset is in a bubble thanks to the fact that that risk-free, so-called risk-free rate of return has been pushed down to near zero for 90 months on a worldwide basis.
And that was Michael Pento and Mike Gleason at moneymetals.com. Live prices at moneymetals.com show gold currently trading at $1,314.10. Silver comes in at $18.72.